Okay. All right. So today, by the grace of God, we have a couple of things to cover. This is the third series, and will kind of be the closing session, the closing class for this session 5. I said in the past, I've combined a lot of the materials that used to be multiple days, and we're able to cover it in 3 classes. Now, there are a number of things I had to take out to make it very focused, but I believe these elements of things that we cover are critical and will be a blessing to as many as take advantage of it. All right, so today what we will do is we'll have a quick recap of the assignment that I gave us after the second class. And then we will finish investment vehicles that we started looking at. We covered a number of them. There are a few to still look at. And today I will focus a little bit on real estate, with the focus being on how to manage a mortgage loan and manage it effectively so that you can pay off as quickly as possible. And then we'll begin to round up the classes. And that will be the end of this session, session 5. Okay, so we had a number of questions. I'm actually going to throw this open to the class. Tolu, thanks for calling in. I appreciate you being on the line. I had a number of questions that had asked us to spend some time to look at since the last class, after the last class, I should say. And I'd like to, if you took some time to answer the questions, I will appreciate your inputs as we go through it. I'd like to quickly just recap what the key messages are, the key points, key learning points, I should say. The assignment was to look at a prospectus that was from Vanguard Institutional Index Fund and answer a number of questions. NAV, which is the net asset value. What capitalization category, what kind of category of market is the asset, is the fund investing in? What's another question? Net asset. So let's, rather than just going through this, I would like to kind of go over what the answers are. So net asset value, I don't know if anyone on the line can provide, can open and tell us what it is for that particular fund. What is the net asset value? Does anybody have the information? If not, I can share it here. If so that we don't take too much time, I can just go ahead and share it here. So you all have that prospectus from your from the chat, the WhatsApp chat. So you should be able to open it directly as I go through it here on this side. One thing I would also like to do actually is I would like to open the other prospectus that I shared, which was for a mutual fund, not for an index fund, so that simultaneously we can actually talk through the differences. So the first question is, what is the net asset value? Let me actually, let's leave it as is, because if I try to do what I was going to do, I might lose the screen. The first question is, what is the net asset value? And that is NAV. I explained what the net asset value is. Is there someone in the class that can remind us what is net asset value and why is it important? I'll just allow anyone that remembers what the net asset value means for a fund. Anyone? Is there anyone that can remind us what it is? Don't be shy, please. In the interest of time, if no one is speaking, I will just keep going. Net asset value essentially is the price of the fund, which is obtained by dividing its assets minus its liability by the total number of shares that the fund has. That's what is called the net asset value. I explained to us during the last class that it is calculated at the end of each day when the fund looks at the value of the investment it owns as well as what it owes as liabilities. It takes a different. So just as you know, in accounting, assets, minus liabilities, is similar to the thought being used there. So the net asset value is the total assets, the value of its asset minus liabilities divided by its number of shares. In accounting terms or in financial accounting terms, they call that the equity. Assets minus liability is called the equity of a company. So for a fund, for an index fund or a mutual fund, its equity is its assets minus its liability, what they own. And similar to the net worth that I explained that we all need to calculate for ourselves, it's the same principle. Your total asset minus total liabilities. We have a lot to cover tonight, so I can't reteach a number of the things. So for this company, it's $189.28. This is from a long time ago. I could go and we could look at what it is now, but this was from 2020, October, $189. I asked a few other things that are in those questions, but I'll just go ahead and go through here. I asked us what the expense ratio is. The expense ratio in this case was 0.012. And the mutual fund that I have displayed on the right frame of my screen, you can see that mutual fund has a much higher expense ratio, 0.31. And I explained to us that even though it looks like 0.2 something is not a lot, it's a lot once you start compounding and it removes from the overall value of that returns of that investment, which is one of the reasons I ask us to stick with index fund rather than mutual funds. The turnover ratio or the turnover rate for this index fund that we talked about is 4%. Those are the kind of numbers you want to see. The turnover ratio, if you remember, it is the number, how much of their assets they sell at the end of each year and put into a different asset. So generally speaking, it's lower for an index fund than it is for a mutual fund, which is what you want to see, because then you don't have the liabilities of frequent trading, the cost that goes with it, as well as the taxes. In today's world, there is a lot of trade that you can execute without cost using discount brokers. So they might not be actually incurring too much in sales or trading costs, but the tax implication of selling a stock less than 1 year is there still for them. Okay, so I just wanted to kind of recap quickly some of those things. One of the questions I asked was, what is the 3-year rate of return? For this, it was 12.27%. That is, on a compounding basis, the stocks has been making about 12.27 every year for the last 3 years. And another question I asked was, what is the comparison between this fund and the S&P 500 over the life of the fund? The life of the fund is actually very short compared with S&P 500. The life of the fund, if you look at the top here, it shows you the inception of that fund. So that fund is only when these numbers were pulled, because that was 2020. This fund was only 4 years, so you can imagine S&P 500 has been for a long time. However, for the life of the fund, the return of this index fund is 15.24. You can see that it really mimics S&P 500, despite the fact that that has been pretty long at 15.23. The index, the mutual fund, on the other hand, that I gave us to also just look at, that one has a return of 13.56% over its life for the same class of funds. Now, that has been in existence much longer. I believe this one was 2001, whereas the index fund is 2016. So there are some differences there. I just want to help you to look at some of what you should be looking at. So calculating what you expect the stock or the index fund to do, that rate of return is what you will be looking at in your compound interest sheet that I have given us. A couple of other important points I wanted to kind of help you to note so that you are looking at when you're looking for a fund. I know that the lettering, I think the lettering may be too small on my screen, but I hope you can still see it. I just wanted the two of them side by side so that we can see the comparison. If you're looking at it on a computer, you'll see it, but if you're looking at it on like a phone, it will be very, very tiny. Okay, so there are some things I want you to take note of. In terms of strategy, the question that I asked that says, what is the market capitalization strategy or something like that, is to kind of let you think about what kind of size of company is the fund invested in. And you can see at the top here where it says objective, it says it tracks performance of benchmark index that measures the investment of returns of large capitalization stocks. I gave us the various breakdown, small cap, medium cap, large cap, and in today's world, there's also what they call a mega cap because companies have become pretty big. So, but the focus here is on large cap, which is I believe greater than $10 billion in market capitalization, which I've explained what that means for us. If you look at a mutual fund, on the other hand, this is how you begin to see the nuances between the two. It says the mutual fund, this example that it says its investment seeks, that word seeks is very, very important. They are seeking, rather than in the other one, it says it tracks. The key word here is track. An index fund is always tracking a benchmark, whereas a mutual fund is seeking to do better than a benchmark, which is why they trade often. And as a result, they incur the negative consequence of frequent trading as well as potential tax implications. So I just want you to kind of grow your capabilities of understanding those nuances. You know, in finance and money, the language matters. If you understand some of these languages, it helps you to appreciate, you know, what they are saying. You know, in many instances, you know, they make people feel like these things are difficult just because it has its own language. So money has its own language, and I want us to kind of be very sensitive. If you've been to this class, be very sensitive to looking at these kind of languages. Track, they are not trying to trade anything. There's already something that they are following. They are tracking the benchmark. Here they're seeking. In fact, if you read a little bit more into it, it says the fund, this is the mutual fund now, invest in stocks considered to have above average earnings growth potential. So they are looking at things that are potentially going to do better than the market. Keep listening. It says that is not reflected in their current market prices. And those that have been in the classes in the past, I explained what they call value investing. Let me quickly explain it to us as quickly as I can. There are two strategies when it comes to investing, two critical strategies, two key ones. One is what they call value investing, and then there is growth investing. What value investing does really is you're trying to look for a stock that based on its market value, its current price rather, it is selling less than its book value. And I can explain that to us a little bit more. I've explained it in some previous classes. The book value is an accounting value, you know, that really shows what the asset the company has. So they can actually calculate what the book value per share is. And if they compare the current market value per share to the book value, if the market value per share is much lower than the book value, the expectation is that a stock price will grow towards its book value. So what this mutual fund is saying they're doing is they're looking for companies that have their market value, the stock current price, lower than its book value per share rather. And that is called value investing. They are seeking to capitalize from the growth of such opportunities. And if you look at the other one, they're not saying anything along. They say the fund invests all its assets in institutional select shares of Vanguard 500 index fund, which employs a passive management or indexing investment approach. And I've explained that, I won't reteach it, designed to track the performance of S&P 500 index. So they are not trying to seek anything new. They are focused on something that is there. I explained value investments. They're trying to track between market price and the intrinsic value of a stock. Whereas a growth stock is different. It's simply looking at maybe a company that is small today, but has the potential of growing tomorrow. It might even be a big company, but has a significant potential of further growth, maybe because of the industry they are in or some other reason. That's a growth strategy. And then there is a blend, and I will show you something down the line. So I just want you to be reading these things. That's why I chose to kind of go through this a little bit. If you look at this, what it says, the fund attempt to replicate the target index by investing all or substantially all of its assets in the stocks that make up the index, holding each stock approximately the same portion as its weighing or weight in the index. So those are the key things I just wanted to kind of point out there. I don't want to belabor it, but I want you to read these things is what I'm trying to say. So you can have a feel along the lines of some of what I've taught us. This one says growth stock can perform differently from the market as a whole. Whereas this, index fund are not seeking to perform different from the market. It says here, growth stock, value and growth stocks can perform differently from other types of growth stocks can be more volatile. Value stock can continue to be undervalued by the market, and that's what I was explaining. When you do the analysis, really and truly, a value stock is undervalued than what it should be selling at. And there are different things that causes a stock to become a value stock, and I won't have time to get into that today. But when you're a value investor, you are seeking to take advantage of the fact that its current price is less than its true value. That's what value investing is. I just wanted to kind of point that out a little bit. All right, let's quickly finish that and go. We have a lot to cover tonight. One last thing I want to show us is this table that you always see, an equity map, they call it, an equity style map. There will be a table that shows that what is their strategy, the overall everything they've been saying in terms of how they select their stock. You can see that they say it's capitalization of the companies that they invest in, a large capitalization. You all should know what that is by now. And they are not focused either on value or on growth. It's a mixture of the two, as it were. Okay, 99%, 98.71% of the fund's assets invest in companies with market value greater than 10 billion, which is what large stock is. All right, I'll stop it at that point. I think, yeah, there was one other question. Let me not forget that. That says, what are the top 10 holdings? As you keep reading, they will tell you the kind of asset allocation. You can see that they have investment. Remember, I told you the key things is allocation and diversification. They have foreign bonds, stocks, both domestics, preferred stocks, cash, those smaller percentage in all these things, but they have across the lines. And the top 10% of top 10 holdings, rather top 10 companies, which makes up 29.2% of their total portfolio, is in these big companies. The usual suspect, I call them, as it were. All right, I will stop there and go back to our session, content. And we can, if you have questions about those things, please feel free to, reach out to me, or you can also still stop us in the course of this class, and I can go back and talk about that. I just wanted to kind of recall some of what we talked about in the last class and emphasize what I would like you to pay attention to, which is please read those prospectus as you start investing. Even if you already decide that you're investing in it, it just helps you to appreciate financial terminologies that most people don't know, and which a lot of these companies tend to take advantage of. They will use terminologies that, if you're not careful, you will think they are saying something different, whereas what they are saying is pretty simple. All right, so that is the assignment review. Let's move on. We stopped at 401k. Any question before I actually move on? Does anybody have any question on that quick recap of what we did last time and the assignment? Any question? Let me just pause for like a few seconds. If there is none, we'll keep going. All right. Where we stopped the last time, we started looking at investing in your company's 401k, and I told us that someone told me that he can't afford to invest. I said you can't afford not to invest in it. The reason I said that, and I explained to us, is it's like leaving money on the table. It's like throwing money away. especially if it is matched by your employer. And even if it's not matched, it's a way to set up an automatic investment and take the emotion out of investing for yourself. If not, you just find out that you're spending before you invest. But even if it is not matched, you're still taking money out. Pre-tax money is a lot of money. So the more you can do that, and I even used a calculation to show us the benefit of pre-tax investment and post-tax investment the last time. So it's always good to do pre-tax investment if you can. I will answer one or two questions very, very quickly, just to help us understand a few things. Now, I explained what an individual retirement account is. I explained what a Roth IRA is the last time. And the question is, can you contribute? This question was someone asked it some time ago in one of the classes, and I explained it, but I just wanted to kind of leave it here. Can you fund both a Roth IRA as well as your employer's retirement plan? And the answer is yes. There are limits which I explained to us the last time. As long as you are within the limit, you can fund both a Roth IRA and an employer-sponsored IRA. The difference between a Roth IRA and the employer-sponsored is pre-tax, Roth is post-tax. Employer-sponsored, the pre-tax money grows tax deferred over time. You owe tax eventually when you take the money out at your normal tax rate. Roth IRA, because you had invested money that was already taxed. If you take it out in the future, you're not owing tax on it. So keep those in mind. Those are the key differences, but you can definitely contribute to both. And I explained what they also call the backdoor IRA, because the Roth IRA has limits. So I explained to Roth the last time that you can go through backdoor IRA to invest in Roth IRA type investment that will not cost you to pay tax in the future. The key is aim to invest at the maximum level. Another question that has been asked in the past is, can I borrow from my employer-sponsored retirement plan, 401k, 403b, 457, that's the government one? Absolutely you can. But you must treat it as a loan. If you don't, that is, if you don't pay it back, it is considered a withdrawal. And if you take it out without reaching the age of 59 and a half, not only do you hold taxes, you also will be charged 10% penalty because you are not yet 59 and a half years old. Those of us that are getting close to that, then you will not be charged the penalty. You know, if you take it, you can take your money at that age anyway. But if you take money, if you start withdrawing before that age, then you hold taxes as well as the penalty of 10% because it's considered a withdrawal. But you can borrow as long as you pay it back. Normally, there's a period that the employer asks you to pay it back over a particular period. As long as you pay it back, in fact, you pay yourself interest, which is good. Okay, if you do leave that company, you're expected to, the balance becomes due. Normally, you're expected to pay it off. Okay, a couple of other key points on 401k, 403b type withdrawals. If you are, once you reach age 70 and a half, you're expected to start withdrawing a minimum amount, which they call minimum distribution, required minimum distribution. It's age 72 for 403b. And those are people working for what is considered non-profit type organization. So keep that in mind. And I have here the tax rates for the money that you withdraw out of a capital gains, from a capital gains in the future. The general term considered long term when you're investing in any of these, equity type investment is more than 1 year. So if you invest less than 1 year, you're taxed at a much higher rate, at your regular tax rate. But if you keep it at least a year, this is another reason why you want to keep your investment long term. If you invest, more than a year, and if you, let's say for the year, you made just 53,000, those numbers, those limits might have changed, but those are the latest numbers that I have. You don't even owe any tax at all if all your income is from capital gain. That is powerful. It made you 253,000 for the year, and you don't owe any taxes. If you take anything between 53 and almost 470,000, it's just 15% that you owe as capital gain tax because it's long term. Okay, some key points to note. Now, the one I've not talked about is college savings. That's the key new one today. There are two key types that I will go over tonight. One is what is called the 529 plan. For those that have children, young children that you're preparing for their college, please keep this in mind. And there's the other one called Coverdell. The advantage of this is that you can invest the money almost as if you're investing in a tax deferred, not almost like you're investing in it, almost like in a retirement account is what I wanted to say. Because the more you don't pay taxes, it grows tax deferred, you know. And also when you eventually withdraw, it is tax-free if you use it for school expenses. They call it qualified education expenses. As long as that is what you use it for, you don't owe tax. That is powerful, you know, way to kind of put money aside and use it for college. And if you don't use it for that, then, you know, there will be some tax associated with it. But generally speaking, you will use it for that purpose. You could also pay, you know, the second side to that is use it as a prepaid tuition plan. There are two types, the savings plan generally, and then the prepaid. What the prepaid method or type does is it allows you to kind of essentially pay in advance for the college today. College, you know, tuition is always going up. So it allows you to pay today at today's price. Okay. The key difference between these two, the Coverdell and the 529, is what I have on the screen right now. There's quite a bit of limitation for the Coverdell. Generally speaking, I want you to consider the Coverdell as more set up for kindergarten to 12th grade, whereas the 529 plan is more for the long term. There is no limit on the 529 plan on how much you can deposit. You can use it even if you're beyond, you know, college age. You can still keep taking it and using it as long as what you use it for is for school. Whereas for Coverdell, there's a time limit. The students must be less than 30 years old or not more than 30 years old. If they are more than that, then there are some fees and penalties that accompanies it. 529, on the other hand, you can use it for a long time. Even an adult, a elder grandparent can still use it to go for school, postgraduate studies, or and things like that. So I feel the 529 is much more set up for college type expenses, whereas Coverdell is more targeted towards lower cost or pre-K to high school type costs. These are the key differences. There's this table. I can share this table with us. I won't go through it individually. But it shows the differences between the two, what the limits are, and all of that. So keep those in mind. That you can do both. Actually, nothing stops you from doing both, and you can take advantage of tax deferment as well as tax, free spending for college when you use the money in the future. And there are a couple of key differences that explain when you should use what on this screen. I won't spend too much time on this, but you can read through it when I send it out. There are a number of other things I want to kind of focus attention on. All right, so annuities, please, like I always say, if there's anything that you want to ask a question on, please feel free to just raise your hand and let me know so that I can answer it while we're going. Annuities is another investment vehicle, and it's essentially insurance, if you want to think about it that way. It's a contract that you make with an insurance company to pay you a regular amount at some other date, either now or some other date. That is what an annuity is. The word annuity is from annual, That is, you get some money on an annual basis. Now, it doesn't mean it's all always paid on an annual basis, but generally speaking, it's calculated in that way from an annual point of view. And you can take it from quarterly basis, whatever, but you have a very, known amount, fixed amount that you get from that contract, as long as you meet the terms of the contract. So it's another element of investment or class of investment that you can consider for those that want it, though it is taxed as a regular income. It's not, it's not an investment in the sense of an investment that has the potential, to benefit from capital gain tax rates. It doesn't benefit from capital gain tax. Whatever you take, whatever returns you get from annuities is considered regular income and taxed as such. Another investment class that I will talk about is bonds. Now, this is very, very interesting. Bonds it's really you're loaning money to a company or to the government. It could be the state government, it could be the local government, the federal government. They all issue bonds. So essentially, you are loaning money to whoever issues a bond, right? So you are buying, a portion of the debts that the company is issuing. That's what a bond is. The word bond really means an agreement between two or more parties. So an agreement is, given the fact that it's a bond, as long as the company is solid, you expect to get the return that is promised. It's not like a stock that could go in one direction or the other. Whatever the promised interest or return on that bond is, you can expect to get it. And the term that they use for their interest, for an interest rate on a bond, is what they call a coupon. In fact, in the olden days, before things became very technologically advanced, they actually issue you a coupon that you will bring back after every quarter or after every 6 months to the person that issued you the bond, and you give them the coupon, you collect the cash. That is in the past. They don't do that anymore. It just goes into your investment account. So it's called the coupon rate of the bond. And then a bond will usually have a maturity date. That is, if the government issues a bond, it might be for 3 years. After that time, they will have paid you your coupon, over the stated period over time. And at the end of the day, they will return your principal back to you in full. So all the money that you made as interest or coupon is yours as well as your principal back. Now, the challenge with bonds, generally speaking, is the fact that if the underlying company, the company that issued the bond, goes south, there's nobody to give you back the money. That's why you hear they say things like, US is one of the best credit rating as a country. That is, the strength of the US economy stands behind any bond that the US government issues. So it's very, very unlikely that it will be in default. If the US government issues a bond, you can expect to get your money back. Whereas if some other countries issue a bond, you may not get it back if the country has a major economic issue. It also is true for some companies. The quality of the company defines the quality of the bond. The underlying quality of the company defines the quality of the bonds. Keep that in mind. So as you're looking at bonds, either through the index fund that you want to buy that's bond focused, look at what kind of companies are inside that fund, a bond fund, they'll call it. Look at the kind of company that's inside it. Be sure it's not lower than what they call it junk rate bond. Those are what they refer to as not being investment grade. Anything, so on the right of the screen, you see what they call the Moody, a couple of rating agencies like Moody's and S&P and Fitch, they rate bonds, every bond that is issued. starting from prime, which is a triple A bond, that is a very solid bond. This company or this government has issued bond over the years and they've not been in default, all the way down to the D, which is companies or countries that always tend to be in default. You don't want to buy it because you're going to lose both your principal and most likely most of the coupon they promised. Below a triple B is referred to as a junk bond or considered a junk bond. Again, the interest or the coupon is high for junk bonds. The lower the grade of the bond, the higher the coupon rates. It's just like anything. The higher the risk, the higher the potential return. So if you can find a company that it may not be rated very well, but looks like it's still, a solid company, you can still invest in it. Just you're taking a little bit more risk. So generally, below a triple B rated bond is called a junk bond. That is a bond that you stand the higher risk of losing your investment. Please ask me a question as we go through this. And the other investment vehicle that I talked about briefly at the high level the last time is real estate investment trusts. And this will also be purchased through funds. So there are funds that target REITs they call them. So they are essentially companies. REITs are companies, but those are companies that, they invest in real estate, and then they issue REITs instead of stocks. They issue REITs. They don't just invest in one building. They invest in multiple properties across various countries, across various places, and they now issue ownership in their company as a REIT. For me, it's one of the maybe not the easiest way, but one of the ways to invest across investment grade or income producing real estate, if you want to be in real estate, which we talked about allocation and diversification the last time. I have answered the question in that respect. I believe real estate is one of the places you ought to be as part of your allocation strategy. You want to have real estate in your investment, either by directly investing in properties, whether it's rental property or maybe for what's it called, commercial type real estate. You want to be in real estate. Yeah, I think somebody raised their hand. Okay, Tolu, you raised your hand. Please
Yes, sir.
Yeah, go ahead, please.
Good evening, sir. So
Yeah.
just a quick one. I might step us back a little based on bonds. So
Yes.
while you were talking about bonds, I did a quick co-pilot check in terms of credit rate, top countries with amazing credit ratings, kind of. And the US was not part of it. So I was just asking myself, what's the feasibility of buying bonds of countries outside the US? Do you have any insights to that?
So generally speaking, I go through, or I will recommend going through your brokerage.
Brokerage, okay.
Yeah, if it is included in the assets that they carry, they will have done some qualification to it. I'm not sure what the search, is pulling and why it's not pulling US bonds. But generally speaking, it might just be that they don't have US bonds available, whatever, at the moment, or whatever, I'm not sure. But generally speaking, because of the strength of the US economy, it is a high grade bond, generally a very high grade bond. And you should be able to buy them through your broker.
The brokerage account.
Yes. Yes.
Thank you, sir.
Yeah. All right. So back to REITs. REIT can also be purchased through your stock exchange, through your stock broker. All of these investment classes, apart from one or two, which I will talk about close to the end, you can purchase through your most brokerage account. I think by now, everybody in the class should have a brokerage account. If you don't, I really want to kind of remind you to please do so. I will get to it in a minute. but please do so as soon as you can. Another investment vehicle are derivatives. Again, my intent is not to teach us about how to analyze a stock specifically in this session. I've done that in some classes in the past. I feel it's an overkill for what people need to know that are participating in this session. So I won't spend too much time on it, but I want to kind of talk about options. So options are different from stocks, even though they are issued, they are dependent on stocks. They are not stocks. They are really contracts. Options are contracts. There are various types of derivatives. I just want to use an option as one of the examples to explain derivatives. So derivatives are actually a kind of financial instrument that was put together based on a different other financial instrument. It could even be properties, A call option, specifically around the stock space right now, is an option to buy. Again, it's a contract to buy. So when you hear the word option, think contract. So what a call option is it gives you that right to buy a particular stock at a future date at a different price. That could be very powerful. Think about it this way. If I buy a call option, think call is buy. Put is like putting something down, so you are selling, right? If I buy a call contract, a call option, and that option says, look, over this particular term or period, they usually have a time to it because it's a contract, you can buy this stock for $20 per share. Whereas that stocks now start selling for $40 or let's say $50 per share. And I already have a contract with me that says I can buy it at $20. Even though the price has gone up to 50, I can buy my whole at 20. You can imagine the power of that. I can then turn around the next day and sell it for 50. That means I'm making $30 per share simply because I bought the contract. But the other side of it is also very, very true, because you are making a bet on the direction of the price of the stock. If the stock, rather than going to $50, went to $5, and you want to buy it, you can only buy it at $20. Will you go and buy it when it's already being sold in the market for $5? Obviously, you're not going to buy it. That is when they say that the option is not in the money. So you don't have the opportunity to actually exercise that option until it expires. And the opposite is also true with the put option, which is the option to sell at a particular price. So let's say you buy an option. So generally speaking, most of these options or contracts, people don't use their own money for it. It's a contract. Eventually, you can just trade that contract and take the difference. But again, you're carrying all the risk. The option to sell, you can sell it in the future, at a different price than the actual market price. Let's say the price today is $50, and let's say it's you make profit from putting, by selling it at a price that is higher, than the market price, as it were. So you make a profit from the difference, of that, as just like the option to buy or the contract to buy, as it were. Okay, so those are the two different. Some individual gets company stock options. It's different from this option. That is just an incentive that companies give some of their staffs to help them or encourage them to stay in the company, because of course you're trying to align your interest with their interest, such that if the price goes up, you can make money because they will have issued it to you at a lower price or something like that. So that's a stock option. But generally speaking, call and put options are more in derivative class. Company stock options are not derivatives. I just wanted to make that distinction because the word option appears in both cases. Now, there are others like gold. These are kind of investment grade gold. I'm not talking about earring now. These are investment grade, precious metals that you can actually buy. Some people actually buy physical gold. because they tend to retain their value. In fact, some countries, their currency is tied to the gold standard. In many parts of the world, it's not so anymore, but in some countries, their currency is tied to the gold standard as well. So it makes gold, kind of precious or valuable. You can invest in that for those that are interested in that, but you can also buy ETFs that invest in precious metals if you want to invest in gold. All right, so let's just finish, with that. That's the last I wanted to say on the various investment vehicles. I've gone through a number of them, and by now you should have been thinking, okay, so what am I going to be investing in? What are the things that I will use to develop my own portfolio? I gave us an idea of what a good allocation is the last time. You don't have to use what I gave you. You can come up with yours, but the key thing is you want to make sure that you are properly diversified across all of these various asset classes that I've talked about. And then you're also, you are allocated properly across as well. So allocation talks about being in these different asset classes. Diversification really talks about, even within a particular asset class, let's say stocks, for example, you're not only invested in small, medium, or large. You're invested in all those three different classes of investment, like I explained a little bit in the past. And then you're also investing in growth, you're investing in value. You're not only investing in companies like Walmart, for example, you are investing in some smaller companies that have potential for growth. So talks about allocation and diversification. So allocation is really participating in these different asset classes. Diversification talks about even within one asset class, you take different types of investment within that class. Okay, keep those in mind. Again, you can reach out if you have more questions. So some key things that I want you to keep in mind is you need to start building your financial cushion. Keep that in mind. I can't say that enough. We need to be disciplined, learn to discipline ourselves, budget. I know that a lot of people are scared of that term, budgeting, but it's such an important term that I want you to keep in mind. It's essentially planning and staying with your plan and properly making sure you're spending time to go over how you are doing on a regular basis so that you are reconciling what you said you would do to what you're doing. Remember to focus on the long term. I just want to leave these three key terms, these key lessons for us. Focus on the long term. Like I said the last time, there was a question by one of the participants. I'm not teaching people how to trade. That's not my interest. I'm more interested in helping us understand how do you invest for the long term and what are the things that will help you if you do so effectively. And then thirdly is asset allocation and diversification. Those are so critical when it comes to financial success. And I believe over the last three classes I've been able to explain that very well. It's very, very important that you don't put all your eggs in one basket. Be properly allocated across the various asset classes as I've explained. And even within one asset class, properly diversify yourself in large, small, medium, blend, value, and growth type of assets. All right. Those are three things that I want to kind of leave with us there as I kind of switch gears a little bit away from these different elements of investment classes. One of the key things today is to kind of focus a little bit around real estate. And I want to make sure I spend some time because there are some people that are participating that have not seen some of what I've shared in the past. All right, so I said this earlier on, please, I can't beg you enough. I wish I have another way of saying this. If you've been in these classes and you've been listening and you have not yet opened an investment account, a discount brokerage investment account, please do so. Please do so. It's so critical. A journey of 1,000 miles, they say, begins with the first step. Please do so. What I'm showing in the chart in front of us right now is the return on investment, of the stock markets over the many years, the last 5 to 10 years, and I should say, really, somewhere in the range of 10 to 13% is kind of what you keep seeing. Now we go up and down, but that's you can calculate what that does, what that means now, And one of the things that I also wanted to point out here is active management, which is what mutual fund does. Kind of reduces your overall returns because of the underlying cost. You can see between the blue and I think the brown is the color there. If you actively manage the cost of that active management, it kind of takes away from your returns. Look at almost 2 points it's taken away in each of the cases, either the 5 years or the 10-year time frame. So my recommendation, which I explained the last time, is to use index funds rather than mutual fund. And one key assignment I want to give you for this class is, if you haven't opened a discount brokerage account, again, please do so. And I listed here, I can share this particular slide also with us, a number of those discount brokers that are in the market today. Some of them have consolidated over the years. Scottrade and TD Ameritrade used to be different companies. But so initially, TD Ameritrade bought Scottrade. Scottrade has a very powerful trading platform, one of the most powerful. But both companies are now under Charles Schwab. So Schwab bought TD Ameritrade. I think it was sometime last year or the year before. So anyway, that platform is now owned by Charles Schwab, a very powerful platform. For those that trade, it could be very, very powerful. And even apart from trading, it's such a powerful platform for analysis and a lot of other things, charting and stuff like that. And then there's E-Trade. E-Trade is now owned by Morgan Stanley. So you can open an account with E-Trade. I think someone in the class was talking about Robinhood. There have been some news lately about Robinhood. I wouldn't open an account with Robinhood. This is just me speaking, but it's also a fairly, reasonable company to look at. Fidelity also has discount brokerage, and then there's SoFi. So any of these these five, should work for like a discount brokerage account. What a discount brokerage account is, really, Charles Schwab is the company that kind of pioneered things in this direction some years ago. In the past, everybody needs to go to all of these people wearing tie to buy stuff. But Charles Schwab kind of liberalized it. Anyone can open an account. And they've actually, when I started investing, for every trade you execute, if I remember correctly, it used to cost somewhere in the range of even $45 per trade. That's very expensive. It came down, kept coming down. And then eventually it came down to like $5. And as of today, I believe none of these companies charge you for a trade, which is very powerful. Any amount that they charge you removed from money that can be compounded. Keep that in mind. So any of these companies are good in that respect. And then keep in mind that I think I said this the last time, but I want to say it again, that I want you, if you're working in a company that offered 401k, 403b, 457, please participate in it. However, don't leave all your money in the company's stock. That is, what I mean by that is, usually, let's say you're contributing 5% and the company is matching it 1-to-1. That means you are investing 10% of your income every month. What the company does is, let's say that 10% is $500, and you're earning 5,000. So, pre-tax, they take 500 and put it in your account. They're not going to keep 500 naira in a 401k in the account. They are going to invest it in the stock, and they will invest it directly into the company's stock if it is a publicly traded company. That's what most companies will do. So if you don't do anything, it stakes in that company stock. And I always tell people, maybe some of us may not be aware of this company called Enron. There used to be a company called Enron in Houston that people left their 401k investment in the company stock, and the company went down the drain. And their investment went to zero. Their life savings went to zero because there's no risk management there. There is no, think about what I've taught us, allocation or diversification. There's no allocation, there's no diversification. It's just in one company, in one stock. It's so contrary to what you should be doing. So when that company went down, they also went down with the company. So if you work in a company that is publicly traded, they will put your money, they will use the money that you set apart every month to buy their own company stock. Please don't leave it in there. Normally you have access to your own account. Just go in and reallocate where the money goes into. And what I typically would recommend is that you should not have more than 30% of that of your 401k in your company stock. Not more than 30%, preferably less, 20% or something. 80% of what you have, the value of your 401k, should be in index funds. You can choose various index funds within your own account, your own 401k in the company. They can't force you to keep it in the company stock. So keep that in mind. Don't leave it in that. And then overall, as I've also explained, use index rather than mutual funds because of the cost associated with it. But the key assignment for tonight is open an account if you haven't done so. And then if you haven't done so, look at what your company is investing the money in and make sure if it's a publicly traded company, it's not just in their account, in their own stock, diversified. Generally speaking, if it's a non-profit organization, they are probably not publicly traded, right? So they shouldn't, what they will have in the 403b account is funds, index funds, mutual funds of various kinds. Make sure it is properly balanced using the thought process of allocation that I've explained to us. All right, we've covered a lot already. I want to switch gears a little bit and talk about real estate. Again, please, if there's anything I say that needs some clarification, feel free to slow me down or ask. I always say this, that if you understand the principles behind what I will teach in the next few minutes, you can pay off almost any mortgage within 7 to 15 years pretty easily. You can, if you understand and you put it to practice. I want you to listen to what I will say, especially if you have not been part of the class in the past. Generally speaking, at the beginning of, if you take a loan to buy a house, a good percentage, usually 2/3 or more of your principal and interest total goes towards interest. And as long as it goes towards interest, it does not reduce the principal. It doesn't reduce the amount you owe. So your goal is to make sure that rather than, you can't stop that calculation, by the way, but you can then take a little bit more and put towards your principal so that you are reducing the principal by yourself. Another strategy some people use is they go ahead and take a 15-year note so that they can pay off faster, which is okay. The only disadvantage that will have is that you commit to a higher monthly payment, in which case, if you have a financial challenge for any reason, you might struggle to be able to meet that commitment. That's the only reason why that will not be advisable. Other than that, if you can afford to do so, the 15-year mortgage is not a bad thing because it automatically puts more towards your principal on a monthly basis. But even if you take a longer time loan, generally let's say 30 years, you can still apply the principal and pay off the mortgage in 7 to 10 years pretty easily. One other key point that I also want to stress tonight is if you pay 20% off the loan, let's say you buy a house that costs 300,000. If you pay down 60,000, that is what they call your loan to value is 80% or less, then you should not be charged what they call private mortgage insurance. Now, this is for private mortgage or conventional loans. It's not for FHA loans. And I can talk about the difference between that as we go along. FHA loans are, mortgage that are backed by the US government, whereas private loan are private banks issuing the loan to you. Those are the ones that you don't owe a PMI on if you pay 20% down. In fact, if you don't pay 20% down, the day you reduce your loan to 80% of the original loan value, not the current market value, because current market value may be higher, but even be lower. You can't go to them and say, oh, the current market value is lower, so my loan is now 80% of the current market value. No, it's the original loan value. So if it's $300,000, let's say you only paid 10%, 30,000, and over time you've paid up your principal down by another 30,000. So you are, you've now paid off, that same 60,000 of the original loan. You can call them up and say, please take out the PMI, and the law requires that they do so. As it were, they should, unless maybe you've done something, maybe you missed a payment or something. If you have not missed a payment or anything like that, they should, take out the PMI. So make sure you follow up on that. Check if you have a loan and you are at 80% of your loan to value ratio, and if it's a conventional loan, ask them to take out the private mortgage insurance, which could be significant, can be an extra $100 a month or more. In some instances, you can start applying that to your loan, and it can save you months of your loan. The chart at the bottom here gives you an idea of, I used it to explain the way amortization work. So at the early stage of a loan, a small amount goes towards your principal, whereas a bigger amount, if you look at kind of the chart, the red is what you pay towards interest, the blue is what you pay towards principal. So over time, what you pay towards interest between your principal and interest keeps reducing monthly. What you pay towards principal keeps going up. You want to pay more towards principal because that's your goal. You want to pay off the principal. But at the initial stage, very little. You can look at the A plus B, the sum of A and B is always the same throughout the life of the loan. So the idea is you can take a little bit out of the life of the loan if you pay a little bit more at the beginning towards your principal, because they won't be able to charge you the interest associated with that. And let me show you that on the table. Actually, I have this Excel that I have open here. I have it on the screen. So I'm going to just switch to the Excel and use it to explain what I'm trying to say over there. So please, let's look at this Excel sheet that I have on the screen. Let's see if it will. Sometimes when I switch to Excel, it behaves in a funny fashion. So I'm going to need to just go on the screen. Okay, so if you look at this particular example that I have here. So this sheet, those that have been in the training in the past, I've shared it with you, but I'll share it with everybody after the class. This is like an example for a house costing 300,000. So all you need to fill in this sheet are the yellow cells. Every other things, I have the formulas in there. So if your own cost, if the house you're buying is $300,000, and let's say you are paying 3.5% down, so that amounts to 10,500. That means the loan amount is 300,000 minus 10,500, which is 289,000. The cell D5 that I have the cursor on right now. Of course, that interest rate of 3.5% is divided, if it's a 30-year loan, into the value on a monthly basis, which is that 0.05 that you have in there. sorry, not the so 0.0, the 3.5% is your down payment. In this particular example, the interest rate is 6%. That is annual interest that you pay for the loan. That's converted to monthly is 0.005. Again, not written as percent, but as a number, so it's easy for the calculation sheet to work. If I put that in percent, it would be 0.5% because it's 6% divided by 12 was 0.005. That's the monthly interest rate. And in this example, it's a 30-year note in yellow, calculated by 12 months a year is 360 months. So the monthly principal and interest, you can see that in the next cell, in cell D8, is $1,735.70. In this example, I just say, assuming you pay 3% as closing costs, it will cost you 9,000. So the total money you need to close is 19,500, which is your part down payment and your closing cost, right? The closing cost does not impact your amortization. It's just money you pay those that are originating the loan for you. All right, so if you go to the bottom of this table that I'm showing us here, there are a number of things that I will quickly show us. So this is, the column A shows you how much time, so it's from the bottom to the top. So this is at the beginning, you have 30 years left, which is 360 months. So the loan balance initially is that same amount that you have in cell D5, 289,500. The principal and interest is that same amount we calculated at the top in cell D8, 1,735.70. Look at the difference between what is going towards interest and what is going towards principal. And this, the calculations that I have running in this sheet is exactly, if you go on any of these websites, go do the calculation, you'll see that it will match this sheet almost to the tenth of a dollar. It's exactly the same calculation that is done. So anyway, the monthly interest is $1,400, almost $1,500, let's say $1,450, and $280.88 goes towards your principal. That's why, many people buy a house and they think that all the amount, in fact, in this particular case, depending on your property taxes, your PMI status, and the amount you pay for insurance, in this case, based on the example, the total amount that you pay is shown in column K. That amount is fixed on a monthly basis. It's $2,412. And people think that amount is going towards the loan of 289,000. No, only 288 of that is going towards your 289,000. No wonder it takes 30 years off to pay. No wonder it takes 30 years off. So the way I explain this to people, for those that have not been in the session in the past, I think many of those on the line have probably seen this, or maybe there are one or two people that have not seen this. Is, you see, imagine if at the beginning of, this loan, you just started, rather than paying just the 2,412 that you owe, you pay an extra $289. So you pay $249.37 plus the $289 on row 15 in column F. What you do by what you achieve by doing that is you automatically save yourself $1,446, the amount that should have been the interest for that line for the life of the loan. They can't charge you that anymore, number one. Number two is you just cut the life of that note, that loan, down by 1 month. Imagine doing that every month. Within 6 months, you've already paid off 1 year of this loan. By the end of 1 year, you've paid off 2 years. I always explain to people that this is valuable. The most time this is valuable, the highest value time is if you do this earlier rather than later. Because if you notice, remember I said it's like an X, the amount that goes towards principal keeps increasing over time. So in the later years, it was 200 and something, it starts growing to 500. So if you wait for many years before you start doing it, for you to achieve the same 1 month reduction, let's say you start in year 15, you need $700 more to add to that 2,400. So instead of paying 2,400 plus 300, which is 2007 at the beginning, now you're paying 2,400 plus 700, which is 3,001. Instead of paying 2006 something or 2007, now you're paying 3,001, almost 3,200. So about $500 more or so on a monthly basis to be able to achieve 1 month, reduction. So whereas if you have reduced it in the early years by 5-10 years, then at this point you don't have to pay the extra 1 month. You can pay just extra 10 days, and then in 3 months you pay 1 month. So you'll still achieve the same, but you achieve it faster, as it were, when it's more valuable. In fact, if you earn some bonuses, you can take that bonus and just put it towards your principal, and it can advance you 5-10 years overnight, on your mortgage. So if you follow this principle, you can pay off, like I tell people, it depends on how you are able to, the things that you face, the opportunities that you have, and all of that. It depends on all of those various elements to be able to effectively achieve that goal of paying it off earlier rather than later, because maybe not everybody can afford the extra $288. But if you can't afford 288, can you afford extra 100? As I was telling some, maybe in this class or so the other time, if you can cut out some things here and there, you can start. That was one of the reasons I asked us to listen to that teaching by Jim Rohn. If you can delay gratification, you can truly put those money towards things like this, an investment in one's future. Avoid taking yourself out or your family out to dinner once 1 week. If you normally go every week, cut it down by 1 week. If you go twice a month, cut it down by a month, turn it to 1 time a month. Those little $50 or $60 here, if you apply it to this, it can help you to reduce a loan amount. I mean, if you follow this principle that I'm explaining here, you can pay off almost any mortgage. I tell people in less than 10 years. Let me just say 10 to 15 years, maybe even in 7 years. Again, depending on how you earn. And then those that earn bonus, this is what you should be applying your bonus to. Not to buy a new car or anything like that, or buy a new shirt or a new shoe. You get 10,000. Imagine if you get 10,000, and then you come in and you apply it to, let's say, after the first year, let's say after year 1. If you go to this sheet now, you're at the end of year 1, you've already paid off 2 years. So you're actually no longer in year 1 now. Instead of being at the 29, row 26, the line 29, you're now at line 28 or row 38. I hope you can see where my cursor is moving to on the screen. You are now on this row that I'm moving the cursor around on. In 1 year, instead of 2 years, you got there in 1 year. And then they now gave you a bonus of $5,000 at work. Let me show you the power of 5,000. If you look at the cells that I'm going to highlight, it will, and then you look at the bottom right of my screen, I want you to see when that comes to 5,000. So it's about 5,000 now. So at the end of year 1, where I'm referring to is this bottom right portion of the screen. See, if you see where it says 5,046 on my screen on the bottom, the sum at the bottom there. Take that 5,000 bonus that you just earned and go to your mortgage company and say, I want to apply this towards my principal. That is at the end of year 1. Remember, you already moved yourself down by an extra year by paying extra, 200 and something, or in this case, about $300 a month. At the end of that year, you now applied that 5,000. It then takes you down to year 26 and 8 months, essentially all the way down in row 52. Not only have you done that to yourself, you just saved yourself about 1,400 times 15. Let me see what that is. So in 1 year, you've already paid off 3.5 years, is the point I'm making there. And you've saved yourself just by paying 5,000. You saved yourself, if you look at the sum at the bottom there, you just saved yourself 21,000 in interest that the bank can no longer charge you over the life of the loan. By paying 5,000, you saved yourself 21,000. And in addition to that, in the course of the first year, you already saved yourself more money, some money on a monthly basis. The cells that I'm highlighting that you can see on my screen, that's another 17,000. So in just 1 year, you've saved yourself like $38,000, if you apply this principle. Let's go all the way to the bottom of the sheet, and I want to show you some interesting numbers. If you just pay minimum payment, you just keep paying that, and you allow the amortization sheets to work the way it's designed by the bank, at the end of the 30 years, you will have paid up that number. You remember the loan amount was $289,500. You have paid it off, but you also paid $335,000 in interest. That's huge. If you look at column K, look at the number there. The actual amount we paid over 30 years is close to $900,000. And it took you 30 years to pay it off. That's a lot of money that you could have used in a much more productive manner to achieve your financial goals in your life. And in just the first year of this 335,000, you could cut out 38,000, was what I was showing you at the top there. You cut out 38,000 by just applying that extra on a monthly basis. So I want to kind of pause there a little bit, see if anyone has any question on what I just showed you. Anyone that I showed this that sees it the first time, is always a big eye opener for them. The truth is the bank does not want you to know this. And if you do, they don't want you to apply the principle. So if there's anyone that has a question on this, there are a number of other things on the screen. I didn't talk about the property taxes. That will vary by area, but the principle is the same. You just need to apply what, the taxes, the PMI, and then the insurance. Just put it in there and it will calculate it for you, what the amount is on a monthly basis. I can pause there for a minute and see if anyone has any question on what I just explained. Any question? Please, this is very, very important. I always like to talk about this because I think if you can remove a lot of this interest that you are paying, you are essentially giving yourself money back that you can invest in other of the vehicles, the investment vehicles that we've covered in the course of these 3 sessions. Whereas if you don't, because of lack of awareness or you're just simply not doing it, you're not doing yourself an advantage. So let me just pause for a minute and see if anyone has a question. Please feel free, if you have a question, to raise your hand. If not, we'll just go ahead and finish the other elements of the class. Any question on this mortgage amortization that I just covered? Especially for those that maybe are seeing it for the first time. I know that I've already explained it to many of us that are online. Any question? All right, so looks like we all understand the point that I'm making here. Please put it to practice if you have a mortgage. I'll share that sheet with us, and please take advantage of it. Now we're getting towards the end of the class. Now that you've learned this much, we've covered a lot of content and material in the course of 3 weeks. The next step is to put to practice what you have learned. I'm hoping that some of us are already doing that. Create your own action plan. Plan out using the step 1 to 4 that I've explained to us from the beginning of these sessions. Deciding, or I won't go over it, again. I believe I shared the video of the other 2 classes on the platform. If you were not in the class, please go back and listen to it. It's very, very informative. You create your plan by looking at where you are at, calculating your net worth, and thinking, where do you want to be? What are the steps that you need to take? Which of those investment vehicles that will help you to achieve that goals? That's kind of essentially what I'm saying here. And once you turn that into a plan, then decide what are the sacrifices you need to make and what are the actions that you need to take. It's called an action plan, I said in my notes, because it's not passive. It's going to require you being very, very intentional. and purposeful about it. It's going to take a lot of your attention, but it's very, very well worth it. And if you don't have a goal, you're not going to achieve, that goal. Someone said the easiest way to, achieve nothing is to target nothing or something like that. So please, let's set a goal. Let's walk towards it. Let's prayerfully take steps that will move us in that direction. I have a few other key things that I also want to kind of share with us. A very important thing I want to mention tonight is I want you to think about creating an estate plan. A number of people think when they talk about an estate plan or something like that, it's only those that have a lot of money. It's not. In fact, the moment you start work and God starts blessing you with something, you need to create an estate plan. What it does is it allows you to protect your wealth, particularly as God begins to bless you. By the grace of God, we'll all live longer and we'll live well. When somebody passes in the future, if you don't have what they call a living will, for example, you open your assets to what is called in law the probate process. The probate process gives the government hand into what you have worked for years to achieve. And they will not allow your family to, just take it. They're going to be the ones that decide who gets what. So be very, 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 very intentional about this. You don't want to go through probate in the future. You don't want your family in the future to go through probate. So set up a living. And I see Tolu, you raised your hand. But before you ask your question, please set up a living will. It's very, very helpful to do so. I pray that God will help us. A trust is a very powerful way of protecting your hard-earned, money over time. All right. Tolu, please go ahead with your question.
Thank you, sir. I wanted to find out for married people, does it have to be individual or it's
No, of course your will is individual, right? Your will is what you want to be done when you pass. So that is individual. But your trust is not individual. Once you're married, so your trust is something that is for the couple. The living will can be part of the documentations for the trust.
Okay.
Yes.
Thank you, sir.
Yeah. This is very, very important, especially for most of us, because we are believers. We tend to put these things away because we trust God that we will live long. By the grace of God, we will live long, we will live well. However, it's just like an insurance. We don't say because we don't expect to have an accident, we will not take insurance. Insurance is good investment. I mean, like a home hazard type insurance or a car insurance. Who knows the kind of person that is going to hit you? My wife was driving somewhere. She was not the one at fault. Somebody hit her from the back while she was trying to exit. But by the grace of God, the insurance covered it. Actually, in this case, not even our own insurance because she was not at fault. I tell people setting up a will and trust is simply along that line. It's just the right thing to do. It does not mean you're not trusting God for long life. It's just the right thing to do. I pray that God will help us as we think about that. There are a number of key nuggets that I've shared in the course of these 3 classes. And I want to reiterate some of them. Number 1 is that don't let fear be what is driving you. Let wisdom drive what you do. Now you have knowledge that majority, and like I told us, one of the things that's painful to me is the African community particularly. We don't think about these things. And a lot of the Caucasian type families they take advantage of this, and usually they are also long-term focused. The right word I should use is they think generationally. Most of what I see of Africans is we don't think generationally. We just think about what we need now, what we need to do now to take care of ourselves, and very, very much understand in some instances maybe someone is struggling financially, and that's okay. But as God begins to help you, let's learn to think for the long term and not just think, I want to make money. Yeah, if you think for the long term, you just take out the potential effect of the fluctuations in the market and take advantage of compounding. Please don't let fear derail you. The market will go up and down. Whatever of those investment vehicles that have gone through that you take, it will go up and down. Don't let it worry you. Maintain a long-term view. And I tell people, when I say long-term, I mean minimum 10 years. That's what your time span should be like. Minimum 10 years. You should actually be thinking 20, 30, 40, 50, 60 years or something like that. And when you're gone, your children can take it forward as long as you train them well. Don't let fear decide for you, please. And also, kind of along those lines, I want to strongly advise against listening to people that talk on the TV around stock market. Many of them, I call them talking heads, Many of them are just journalists. They know nothing about what they are talking about. And people listen to what they say and they use their decision. They base their decision on it. Base your decision on sound evaluation using the things that we've covered in the last few months. It's months because we've just been doing one training per month. Base your decision on sound principles. Don't let fear rule you. Don't let it direct you. Don't let it be short-term focused. And I also explained to us that investing is like farming. You don't see any farmer that goes to the ground the next day and is looking if what he has planted has grown. It doesn't happen, The Bible says in John 12:24 that unless a grain of wheat falls to the ground and dies, it abides alone. But if it dies, it produces much fruit. That is the way you need to consider the things that you invest. Consider it as money that is in the ground. Let the law of farming take hold of it, and then it's going to bear much fruit. The Bible also says that he that goes forth weeping, bearing his seeds with him, he will doubtless come back rejoicing, bringing back his sheep with him. Sometimes investing feels like it's a little bit painful because you're not using that money to cover some expenses in the short term. But according to the word of God, you will have returns you will doubtless come back. Sow your seed and leave it in the ground. You are not, you're not doing yourself a favor, doing the right thing. If you're thinking about this, okay, I want to make $50 here, $100 there. You might make that $100, but imagine if you leave it in the ground and allow it to grow over time. Please keep those key nuggets in mind. And as God blesses you, I pray that God will give you the wisdom to be a giver. See, a lot of these principles, I want us to, as God's children, think about it from the point of view of the fact that it is God that blesses us. The Bible says it's more blessed to give than to receive. And as God blesses us, let's be givers. There's so much blessing in being a giver. Winston Churchill, at one time, UK Prime Minister, says we make a living by what we get, but we'll make a life by what we give. I pray that God will help us. It doesn't mean giving money all the time. Give of yourself, to others. Seek opportunities to be a blessing to others, and the Lord will help you. The graces that God has placed in your life, let it be a channel of, blessing through those things, and the Lord will help you as you do so. A few more key points is that you need to open your brokerage account. If there's anyone, I will repeat this on the line that has not done so, please, I beg you, do so in this week. You can do so tonight because you can open these accounts online. You can do so tonight. Forget about funding it, just open it. And I explained the law of attraction to us the last time. It's amazing how much it works. The moment you do that, it's like your mind starts to think about that. Somehow it works. I pray that the Lord will help us to take action if you haven't taken it. I also said that you should steer away from actively managed funds, what they call mutual funds. Use index funds. Maximize your contribution towards your employer-sponsored retirement accounts, students, which I explained a little bit today, college savings, as well as individual retirement accounts, IRAs. Your goal is not to lose money. Someone asked Warren Buffett that what is the first principle of investing or something like that. He said the first principle is don't lose money. And they said, what is the second principle? He said the second principle is if you forget the first principle, don't forget the first principle or something like that. Don't lose money, And you will lose money if you're short-term focused. I can assure you of that. The only way to really, truly do this is to be long-term focused. Remember, diversify and asset allocate properly. It's very, very important. Invest continuously. Don't wait for a perfect time. There's never a perfect time. In fact, I tell people, I think I said this in one of the last classes, that ladies are the ones that I see that understand this. Unfortunately, I don't see them apply it in the area of investing. They like sales. Anytime the stock market is going down, is stock going on sale. Yet that is when many people sell their stocks. That is not when to sell your stocks. That is when to buy stocks. When the people are saying in fact, they call it there's blood on the streets in the market world, in the investing world. When there is blood on the streets, when other people are running, it's also called the bear market. When other people are running, that's some of the best investment opportunities. Now, there are some investment that we did during COVID that has done so well for us. But most people were selling. In fact, the reason the price of those stocks or indexes go down is because the law of demand and supply is in place. There's a lot of supply, so demand is lower, and as a result, it puts a lower pressure on price. And that is when you should be buying, not when you should be selling. Please keep that in mind. That is one of the best times to buy, when people are afraid. That's when you should be greedy, actually. And then whenever people are saying, oh, the things are going great, that is when you actually should be more careful. And educate yourself. Invest in educating yourself. Invest in educating yourself. I pray that the Lord will help you to do so. I have shared a couple of books. I was so excited. One of those that just joined us sent me a picture of the books that were delivered, after I posted that they should be purchased. I was so excited on that day because that shows me somebody that is really going to do well in this subject of investing and financial independence. As I said at the beginning, it's really about becoming financial independent. That really this is all about, to the point that you can be a blessing to yourself, a blessing to the church, a blessing to your family, and all of that. We should not be at the mercy of a company or anything like that. And there's such an open opportunity to do so. And sometimes it's really lack of knowledge that is a disadvantage. That's why the Bible says, my people perish for lack of knowledge. Please invest in your mind. Read those books. If you haven't read those books, I want to implore you, please read them. I will continue, even though we're finishing today, I will continue to share maybe a video here and there online, on our WhatsApp group, I should say. Please listen to them. The one that I shared, I think I shared it 2 days ago. I repeated it today by Jim Rohn. Was so powerful. I've listened to it, but I keep listening to it. So powerful in terms of principle. Things like that are short, but they can be very, very educative. Similarly, books, please educate yourself. Grow your understanding. They cheat a lot of people because they don't have, this basic knowledge. They cheat. This system, the American system particularly, is designed to cheat those that are ignorant. And I've explained, I've given my own example in the past. It's designed to cheat you if you don't know. So knowledge, they say, is power. But really and truly, you need to apply it to get advantage of the power. Pray that the Lord will help us. Okay, I can't say this enough. Maintain a long-term perspective. Let's delay gratification. Let's delay gratification and forward. Focus on long-term goals. The Lord will help us. These are the same set of books that I've asked us to read. And again, I know that reading may not be easy for everyone. And I think I've said you can also do audiobook. It's as powerful, maybe not 100% as paper book or hardback, but it's very, very educative because you can listen to it in your car while you're driving, and you can educate your mind. I drive, about 1 hour every day. I don't spend that time, listening to music. Now, it doesn't mean I don't listen to music, please don't get me wrong, but I use the time to listen to teachings, and it's been a blessing. It's like going to school. When you do so, please use audiobooks. There are different types of audiobooks that you can take advantage of. But these 5 books, the total money order, my money makeover, in this order is what I recommend. Even if you can't read all of them to start with, at least read Total Money Makeover. I strongly recommend it. And then there's this very small book called The Richest Man in Babylon. Very small. You can read it in 1 day, but very powerful. Rich Dad, Poor Dad, a very popular book by Robert Kiyosaki. Most people don't know Tony Robbins in this subject of finance and money. It's almost like it's saying more as a motivational speaker. But this book is one of the best books I've read. So I strongly recommend it. I mean, on this subject. And one of the real age-old people to read their books is Ray Dalio. Ray Dalio, he founded Vanguard, one of the first people that truly helped to develop principles around index funds and things like that. Please read this book if you can. Ray Dalio, at the minimum, listen to it. I pray that the Lord will help us. This is where I will end the class. I always like to end with this particular slide that I pray that this has been a blessing. I hope it's been a blessing to you. And I ask that, Pastor, please, I see your hand. Can you please go ahead and ask your question?
Good evening, sir.
Yes, sir.
Thank you so much for taking your time out to really bless us. I pray that God Almighty will always continue to bless you and your family.
Amen.
In Jesus' name.
Amen.
Amen. I mean, this has been a really, if you charge us for this, I actually don't think that we will complain at all. It's a lot of information. For even some of us that have a little idea, it also helps to crystallize what we already know, and also give us a different perspective to understand for a more expert view as yours. So I really want to thank you for doing this voluntarily. Thank you, sir. So 2 questions that I have.
Yes, sir.
In fact, since the second class, I went through my 529. I set up 529 for my kids.
Excellent.
In 2012.
Okay.
So I have an automatic contribution of 330 for the 3 of them. So that's like 1,000 a month. Okay. And I did that because my state has a tax write-off up to 3,000 per child. So that was the reason why I actually did it, to just maximize my tax advantage. So after the last class, and at that time, when you're doing something and you're not even, doing something like a blind man, don't know why you do what you did, right? So I set it up and I just went to, because at that time they were young, I put in aggressive portfolio. I didn't know what I was doing, So just after last class, I now went to look at it. and I realized that over that 12 years that I've put in 330 per month, about 40 something for 47,000. But I mean, the two of them are in college already. One finished, one is sophomore now, you know, just only the last one is in high school. So, but I look at it and I find out that those portfolios actually performed, you know, more than I put in. I thought what I was putting in was what I was seeing, but that was not. That was one of the accounts. Each of the accounts went up to almost 80,000. I thought that was what I was putting in, not knowing that what I put. So I went to calculate after the last class. I found out that I only put in about 47,000. If you do 330 per month for 12 years. But the account actually performed, which kind of shocked me. I didn't know that you know that time, that power of compounding, you know, the time was going on it, and I never realized that it was yielding anything. I do get statement, I don't look at it. I get it, I toss it, I get it, I toss it. You know, so I mean, so just to have to, to encourage my fellow students here that these things do work, you know, but if you don't give it time, you may not know when kids are going to school, and then, you know, if they're lucky to go to an Ivy League school, it's a lot more expensive, you know, it's going to cost a lot of money. So even with scholarship, it's still going to cost a lot of money. You know, traveling out of state, you know, to another state back and forth is a lot of money. So he's going to help you offset, you know, part of your and then of course he's a tax write-off for Wisconsin.
Yes.
So that's the second advantage. So I just want to thank you for stressing all these things, you know, as a tool, because sometimes we look at all this extra money that we're putting aside as inconvenient, but I think it works well at the end of the day. So thank you for that. But my question is, so like after this last class, no, actually the first class, I opened 3 individual accounts.
Okay.
One each, one in Schwab, okay, which already have my 401k, and then I did an individual brokerage like account.
Yep.
I opened another one in Fidelity, and then the Fidelity was a traditional IRA, okay, and then I opened a third one with Robinhood. Okay. You know, and I tried to fund everything, just max it out on each of that account, and then I'm doing it myself. I just went on the thing. I read the books. I also bought 2 of the books that you told us to buy. And so, I mean, I already finished one of them. The second one I just went through, just flip through. But I didn't read it like the one that I actually read from back to back. I will tell you right now, the one I read. So I read, so for Tony Robbins, I just listened to the audio. So I did that. But for Principles by Ray, you know, that was actually very interesting to read. I have the book. I bought the book. I read it. So you know, I went on the brokerage account, and then I bought. So the Schwab one, I bought individual stocks, DFLI, you know, all those things. I bought one, and then that was for the Schwab account, and then for the traditional, the Fidelity account, right? I bought these ETFs, okay, you know, SCHD, you know, all those names, right? Okay. So, and then at some point, I've been watching for the last two months now, and I keep hitting myself for the Schwab because I think those individual stocks are losing money, you know. I mean, up and down, and I'm like, okay, this is actually good for people who have time to trade, you know, whereby, because I think I missed some, because I'm so busy, I missed some time when 1 or 2 of the stocks went up. I could have probably sold it. A friend of mine was telling me that one could set it up to sell at a certain point. I don't know how to do that. But I found out that I missed some time when 1 or 2 of the stocks really went high, and I didn't check. And then when I was checking some, you know, in retrospect, I found out that I could have sold it. I just make money on those individual stocks. So maybe as time goes on next year, I will pay more attention to those. For the ETFs in the traditional one, those are doing really well. I mean, it's short, it's only a month or 2 now, but I could see that they are really, you know, hedging up a little bit at a time, which I'm very happy about. The one in Robinhood, I've not done anything. I just put money there. I've not invested it, but I will do that before the end of the year. I don't know how to, I mean, you know, because the website is kind of more, you know, complicated a little bit than the other 2. So I just put the money there. I've not really invested it. But my question to you though is that for the traditional IRA that I have in Fidelity, how do I do the backdoor Roth? Because I wanted to convert it to backdoor Roth. I called them, they sent me a whole long sheet of instructions that I just can't follow that. I'm not too smart at, So, but I want to do it. And I asked a friend of mine, do I need to do it before the end of the year or can I do it at any time? So I just want to ask you those two questions. Thank you.
So you've said a lot, and I just want to be sure I don't forget any of it. Okay, so first of all, I want to really appreciate you kind of giving us the example of the college account that you said, and how you were surprised the value of it, over time. 330 for each child in a year is what, like maybe 4,000, like you said.
Yes, 2012.
Yeah, so times 12 is like 40 something. Now it's going to 80, 90.
Yes.
This thing works. I can't say it enough. Pastor, there was a time that so many years ago when I sat down and I started thinking about some of what I'm teaching now, set a plan, and I looked at where we were as a family financially, and by the grace of God, I set a goal for a number of years down the line. And I kind of just felt that goal was kind of too much out there. Pastor, when that time hits, we actually achieved that goal. I'm like, how did this happen? In the midst of everything else that was going on, how did this happen? But my point is, this thing really does work, number one. Number two, you can't hit a goal that you don't, a target that you don't set. It doesn't happen. So please listen to what Pastor has said. He gave his own example. I pray that God will help every one of us to kind of take steps in this direction. The other thing I want to talk about, Pastor, is on the stocks that you said have gone down. Please don't bother yourself about it at all. Don't. In fact, and I think I said that tonight, when a particular stock that you have invested in goes down, that is your cue to buy more, not to sell. Because if you sell, you lock in a loss. Let's say you bought it for $50 and it's now selling in for $40. You're locking in $10 per share. You don't want to do that. You actually want to go in, and there's what they call dollar cost averaging. Imagine if it was only one you bought at $50 and you now buy the second one at $40. You now have two. Your equivalent share price is now gone down to 45. So your break-even point is even lower now, overall, than it would have been if you didn't buy another stock. In fact, it's always contrary to human, how do you say it? Human nature. When you see the value of a particular stock going down, the natural thing that we want to do is that we want to sell those stocks. Whereas that is exact opposite of what we should be doing at that point in time. So I just want to encourage you not to allow the fact that it is going down to kind of make you, why did I put money? No, that's exactly what your natural mind wants to do. And that is the exact opposite of what you should be doing. I hope I explained that well. Don't worry about it. Just leave it there. Remember, your time frame is not the 3-4 months, Pastor, that we've been in this class. Your time frame is minimum 10 years. So what a stock has done in 3 months means absolutely zero. It does not mean anything. All it means is that you've put some money somewhere and it's doing whatever. If there's anything you want to do at that point, is to buy more, not to sell. I just want to make sure that I re-emphasize that, Pastor. It's so important that you don't allow yourself to be spoofed by the fact that your stock price, the price of your stock has gone down, because that's the natural thing to do, or that's the natural thing we will do. The third thing you talked about is the backdoor IRA. Now, that's a good thing. I explained it to Ross the last time. That it's a good thing that, one is earning beyond, let me share my screen, entire screen. One is earning beyond where you can do an IRA. Let's see. Can you see my screen? Yes, I think you can see. One is earning beyond the limits of Roth IRA, because Roth IRA has limit, has income limit. If you are a single person, if your adjusted gross income is more than 150, ideally you cannot do a Roth IRA, regular Roth IRA. And if you're married filing jointly, once you start making together more than 236,000, you can't do a Roth IRA. But thank God for the rich people that they want also that makes the law, right? So they went to the government and they make them create this system that, oh, how can you say we cannot simply because I'm making 300,000 or something like that? Anyway, the backdoor IRA is actually not really a direct IRA, if you want to call it. They call it backdoor because it's really a way to file your taxes in such a way that you can take advantage of money that you can put aside without, owing taxes over it. That's what it is. So the process, it's not too late. The process is, I think I explained this in one of the classes. It's not officially a retirement account, so you can't just say you want to convert it. Well, the process you go through is 3 steps. One, you open a traditional IRA. So you can't open a backdoor IRA. You can't convert a traditional IRA as it were. You open a traditional IRA and then you contribute into it after tax. Once you contribute into it, then you will file, during your tax, you'll file Form 8606 when you're doing so annually you find that Form 8606. And then you roll over the traditional IRA into a Roth IRA. It's called a Roth conversion. So that's the 3 steps you go through. So what you open is still a traditional IRA, but the money you put into it is post-tax money anyway, because it's traditional IRA. Now, it still follows the limit, you can only make a maximum of 7,000, but 8,000 if you are more than 50 years old, into that traditional IRA account. Then you file Form 8606, IRS Form 8606, which allows you to roll over the traditional IRA into a Roth IRA. That's really the process that you go through for a backdoor IRA. Does that make sense?
You can do that every year, sir. You say
yes,
annually.
Every year. Annually. Because really you are beyond the income level that should participate in a Roth IRA. But the moment you now have this conversion done, then it becomes a Roth IRA. Even though you earn beyond where you should be able to participate, it becomes. So let's say this 8,000 now grows to become 90,000 in future. You don't pay tax. But if you don't convert, and by filing this form, then it stays as a traditional IRA. And since it's traditional IRA, even though you made post-tax contribution, it's only the amount you contributed that you don't owe tax on if it's traditional. So let's say it grows from 8,000 to 90,000, like as I explained. The extra 82,000, you owe tax on that when you collect it. Whereas if you do this conversion, you don't owe tax on any of the 90K. So you need to go through that process. You can work with a CPA, and then they can make that process really seamless for you and file it for you directly. In which case you're not having to do it yourself. But you have to convert, to be able to participate in this process.
Thank you, sir. So 2 questions quickly. The Form 8606. So that has to be filed before. So for this year now, before the end of this year, or before the end, or before April 16, where we file taxes.
Exactly, before you file your taxes.
Okay, so before April. Okay. The second question is, so now we have 2. I mean, if you're going to do so now for the traditional IRA now, if you want to roll it over to, under the Roth conversion to Roth IRA, so that means that we will have 2 accounts now, right? One account is the traditional, the other one is the Roth account.
Yes, because the other, it's almost as if you wanted to open a Roth and a traditional.
Okay.
Because ordinarily you wanted to do both, but because your income does not allow you to do that, then you're opening both as a traditional.
Okay.
And then you convert one into a Roth. 8K maximum every year.
So you keep moving money from the traditional into the Roth every year. You move the money there from there.
Yeah, it will be
From
converted
one to the other one.
to move. You just convert it.
Okay.
Yeah.
Okay. Okay, sir. Thank you, sir.
Thanks. I think that's very educative for those that are listening as well. For those that are earning at a point that you're not able to participate in a Roth IRA, I strongly recommend that you think about the option of doing a backdoor IRA, following this process that the government has put in place. Again, you're not going against the law, you're simply following the law. Yeah, Sister Desola, I see your hand is up as well. Thank you, Pastor.
Yeah, can you please explain more about the EFT?
EFT is an acronym for electronic traded funds. Excuse me. And really what it is it's like an index fund. But you remember, as I explained to us, that funds, index or mutual, they don't get traded like every minute like a stock, right? What the way it works is at the end of the day, let's say there are 500 companies inside the fund. The overall price of all those 500 companies are converted into the net asset value at the end of that day, and that becomes the price of that stock for the next day. So there was no trading going on the fund during the day. So they created an ETF which does essentially what a stock does, but within the fund, within that fund, same fund. So it's traded like on the same microseconds as a stock, right? So really that's the difference between the two, between a regular fund, index fund, mutual fund, and an electronic traded fund. It's traded on a higher frequency. And every other thing that you can invest in through like a mutual fund or index fund, you can invest into it through a ETF as well, even some other more things. Yeah. The only disadvantage of it is really that you have the potential impact of the cost of trading and taxation that goes with short-term trading.
Okay, so it's like more of a short term.
It is short-term.
Okay.
It's definitely short-term. It's as short as seconds even.
Oh, okay.
And how quickly they trade the elements of your fund.
Fund. Okay.
Yeah.
Okay. Thank you.
You bet. Good questions. Any other question? The class is finished in terms of content that I want to cover. So it's open for question and answer like we're doing right now. If any other person has a question, thanks to Pastor and Sister Desola for the questions. If there's no other question, I want to appreciate everyone that has participated in these sessions. I want to kind of, encourage us, like I said earlier on, to please remember the things that I've said. Start small, but think about where you're going. Think through what you want to achieve. Use the principles that I've taught in the course of this last couple of, I know we did it over 3 months, but it was really 3 classes, right? Think through the things, do your net worth calculation, work on your budgeting like I talked about. I've given us templates that we can use. Please take advantage of those things. Do it, use them. It's going to take a little bit of work from yourself, especially when you just started. It takes a little bit more effort because you've not done it before. But I can assure you it's going to pay a lot of dividend. With time, it's going to become simpler as you get more comfortable with it. I ask that you please don't let this just be, you've already invested 2 hours, 3 sessions, that's 6 hours, almost a full day of your time in this. Don't let it go to waste. I really want to seriously advise that go through the materials that I've shared, go back and listen to the videos. If you've forgotten a part of it, also feel free to reach out to me, as I've been saying it multiple times. I pray that God will bless all your efforts, and by the grace of God, you will have good health, long life, sound mind to enjoy the blessings that God will bring into all of our life. I pray that you also, see this as an opportunity to be a blessing to somebody. Share this knowledge. Don't keep it to yourself. Share it. In fact, the more you share it, the better you'll find out that the better you get at it. Share it. You can invite people to be on the platform. I shared the link, on the platform on how someone could be. I'll continue in the course of now and the next session. I think the next session, because I'll be traveling a little bit in January and February, so it's not going to be in January and February. I posted the date. I believe it's in March. We'll start our next three sessions. Even though you've been in this, please feel free to come again. I always add to the material or change things here and there as the Lord helps me. So you might be learning something new if you come back. But more importantly, encourage those that have not been part of this to come and learn something that will be helpful to them. I pray that the Lord will help us as we take this and put it to practice in Jesus' name. Thanks, everyone. Have a nice evening, nice weekend, and I wish us all Godspeed.
Thank you so much, sir.
Thank you, sir. God bless you, sir.
Thank you, everyone. Have a nice evening.
Thank you, sir.
Thank you, sir.
All right.
Thank you, sir.
Absolutely. My pleasure.